Welcome to another edition of Focus on Alternatives, a partnership with Adisa and Real Assets Advisor magazine. Today we have Matthew Malone with FS Investments, and we're going to be talking liquidity on alternative investments. There's a lot of value to having non-correlated investments or investments that are locked up and not traded, but in order to get total return, you must have a liquidity event. So Matt, can you walk us through what are some of the typical liquidity events out there?
Sure. So first of all, I love the term, right? Liquidity event, very exciting thing in the alternative space, and historically something that we've focused a lot on. Now, with a new regime of products, we're seeing a lot of products that aren't as focused on major liquidity events. They may be focused on minor liquidity events or liquidity occurrences, but where we've come from and where we're going, there's still a lot of money in less liquid alternatives. And I've heard numbers as high as $18 billion worth of liquidity events this year, and many multiple billions of dollars in the future. So a very important thing to focus on for investors. Now, to your question, Greg, the three main things people focus on in terms of liquidity events in alternatives are the ability to list, liquidate, or merge.
Got it. So when you talk about mergers, we've seen some more things in the news recently about different mergers going on between sponsors that have multiple programs. Can you tell me what's driving that?
Sure. I mean, maybe it would help to go through each one of them individually. So we talk about liquidation, right? And I think it's important. That is always an option. But I think what's important for people to remember is that when you go to liquidation, you may be leaving some value on the table. So a lot of these less liquid alternatives, what they're looking to do is they're looking to, on one hand, aggregate assets, right? So if you're able to aggregate assets, you may be able to generate value that's in excess of those assets individually. And then another thing sponsors are looking to do with liquidity events is generate a liquidity premium, right? So hopefully when you are managing illiquid assets, you are generating an illiquidity premium for investors. And by moving into a liquidation phase, you can then realize that value in the public markets. Now, to your question directly, the merger activity we're seeing may be driven by both of those things. So you may be looking at sponsors looking to get some programs to scale. So in order to get that aggregation premium, you may want to merge some programs together in order to get on the public markets. You also may want to gather some assets in other ways. So there's a lot of different things that could drive merger activity, but ultimately what it should be driven by is providing additional value to investors.
And I think that's a really key point that you just made there, because sometimes when they're merging multiple programs, these can be construed as, or they are affiliated transactions, and some people frown on that, but it's actually in the best interest of the investors, and so that's a good thing. Of all the different types of liquidity events, are there some that is more successful than others?
Yeah, so that's a great point you made initially, Greg, was making sure it's in the best interest of investors and that you have to look at how these programs are merged together, right? So when you're looking at affiliated programs merging together, there's a lot of different ways to do it, but this is something investors should be very aware of, is looking at how those decisions are being made. Are there independent valuations being done? Are there independent boards involved when those are merging together? And all those pieces are important parts of the puzzle in terms of getting towards a successful merger or liquidity event, if that's what you choose. Now, what ultimately makes a liquidity event successful, I think, is delivering on whatever your ultimate strategy was for investors and ultimately your returns, right? Investors are looking to generate a high level of return. They took some risk going into an illiquid product, and they're looking to generate some additional returns coming out of there. So I think ultimately that's the definition of success, is fulfilling your promise to investors in terms of timing and overall return expectations, and supporting that program in the public market or in a merger or in a liquidation phase, if that's what you choose to do.
So then liquidity events are always positive for investors?
Well, certainly not. I mean, you hope they are. Liquidity events have to be very, very well managed. And if you think about listing, for example, which is one of the most common liquidity events people talk about in the space, a lot of people think of it very simplistically. You just list something on the public market, and if it's a good program, it trades well and everything goes fine. When in fact, it's a much more complicated thing than that. When you're listing an illiquid product, you have to match all those potential sellers that are in that product with potential buyers. So how do you do that? There's a lot of effort that goes into, if you're a sponsor that's listing a program, generating that demand in the public markets. If you think about an example, I have 3 young children, and if I think about them cooking brownies, okay? They may cook the best brownies ever, right? And I may think they're the most fantastic brownies in the world, and I may tell my kids, go out and put those brownies, you should sell them in the driveway, and we're going to charge $10 a pop because they're so great. Now, if I were to do that day one, and I wasn't to tell anybody about it, and we just went out $10, I think you'd have a lot of people driving by and not buying those brownies, and you'd probably slowly lower the price over the course of the day until maybe they're $1 each, and some people feel bad for your kids and they start buying the brownies. Now imagine if instead I went around the neighborhood before that and gave a sample of some brownies to people, told people about how great these brownies were. Now all of a sudden I have a bunch of buyers. And now all of a sudden I have some people interested. And maybe that $10 price isn't as crazy as it was in the first place. Maybe people are willing to pay that. When you're a sponsor, you have to do the same thing in the public markets. You have to educate the public markets on the value, your value proposition, and as to why you're listing this vehicle and as to what price is appropriate in order to support that listing. You also want to lower the selling pressure from your current investors. So maybe some investors want to get out, but maybe you want to tell some investors why they want to continue to hang on. So there's a lot of things that go into a successful listing.
I think you brought up several good key points there. What are the key risks that investors should be focusing in on when it comes to liquidity events?
It's a great question, Greg. It's very complicated. So the answer is it depends. It depends on the particular liquidity events. And like any good lawyer, I have some legal training in the background, it always depends. But I think what you have to focus on is everyone's interests being correctly represented. You also have to look at, was the vehicle structured differently as an illiquid vehicle versus a liquid vehicle? There may be some fee changes that go into place that could significantly impact performance. There may be some lockups in place in order to dampen that selling pressure and hopefully increase the price. So there's a lot of things coming into play. Also, investors may want to look at, what are the public markets trading like? Is this experience going to be more volatile once I go into the public markets? So all these things come into play when you're talking about that type of event.
So investment managers really have to be savvy with listings and understand Wall Street, and they can't just be good at real estate or private equity or what are their asset classes. They really need to understand that full cycle model when it comes to listing. But that's the manager. Do investors have a say-so in when there's a liquidity event?
Again, it depends. I mean, in most models, investors do have a say, particularly if it's a program with an independent board of directors. There's typically a shareholder vote. But even if it's not required by the particular investment program's bylaws or organizational documents, typically a sponsor would want to go back to its investor base and make sure that its investors are on board, because if you were to go towards a liquidity event and not have that investor support, you're walking into a potential disaster for everybody.
So speaking of disasters, have you ever seen any liquidity events go wrong?
Certainly there's been some that I think haven't gone as well as people have hoped they would. And I think, there's a lot of factors at play. The public markets are fickle. And if you try to force a liquidity event at a time where maybe that asset class is out of favor, you may not see the results you're hoping for. If you do something where you're not appropriately valuing assets, or if you're merging programs and you're maybe treating one program not as well as another, that may not go so well. We've also seen some mergers where rather than looking to grow towards that aggregation premium, sponsors may be merging assets from different types of vehicles that don't necessarily fit together all that well, and maybe that doesn't go so well. So there's certainly things that could go wrong, but hopefully for us and for the entire industry, most of them go right.
And I like that trend. And I like that trend. Any last words of advice regarding liquidity events?
No, I mean, it's back to where I started. I mean, I think it is a really interesting structure we have in this space where we raise money in this illiquid product and we move towards a liquidity event. It's certainly something that can be very exciting and hopefully very positive. And I hope that all the investors and sponsors are out there pay very close attention to these events, because it's the way our industry is viewed in the broader investing public.
Well, Matthew Malone, thank you for joining us today and talking about liquidity events. And thank you for watching. For more information about alternative investments and how they may go full cycle, visit adisa.org or realassets.advisor.com. Thank you.